Good morning, everyone. Thank you so much for joining us this morning at Resolution Foundation. Today's report is part of our project called Unsung Britain, which we're very grateful to JP Morgan for sponsoring, which looks at the experience of low and middle income families over the last 20 years. Often we think about that in terms of income, but today we really want to zoom in on the balance sheet side of things and on family savings and debt. And I think we find some grounds for optimism and some quite worrying new trends. So we have a really excellent panel to help us unpick all of that. I'm delighted to be joined by Vicky Brownbridge, Chief Executive of StepChange, which is a fantastic charity that gives debt advice and support to people across the UK, by Seb Burnside, Group Chief Economist at NatWest Group, who, among other things, can hopefully give us an insight to some of the more recent trends that it can be hard for us to get at through the data. And Tim Jarvis, Director for Markets at Ofgem. As you will see, the energy story is a really important part of what's happened here. So I'm really grateful for Tim for joining us this morning. And last but certainly not least, Felicia O'Dampton, who's a researcher here at Resolution Foundation and is moving to the Bank of England shortly. So this is also her last report for us. And what a way to end. And we're really grateful for all your work, Felicia. But you're going to kick us off telling us a bit more about the report.
Yes. Cool. Right. Thank you. And thank you all for being here today, because I know it must have been a bit of a struggle during the tube strikes. I'd also want to thank my co-author, Simon, who can't be here with us today because he's enjoying the sunshine in South America. So it must be nice. So I'm going to kick us off. At first, I want to say in this Unsung Britain project, we've been looking at the poorer half of households as defined by their income, which Ruth said. But there is more to living standards than income alone. So this paper continues to look at that half, but looks at the wider picture of financial resilience, specifically looking at household savings and debt. So what we know is that savings and debt are really important to people. And here are just a few quotes from people we interviewed in our research. I'll read them out quickly. So having low savings makes you think about money more and what could go wrong and where that money might need to go instead. Someone else said, having a lot of savings makes me feel a bit more well prepared, but at the same time, just happier. I feel more secure. It makes me feel like I'm not in a rat race as much as everybody else. And then finally, if debt outweighs my savings, that is a bit of a stress point. So that's a few quotes to illustrate how important this topic is to people. And while long-term wealth is a measure of resilience, aggregate figures don't really tell us enough about the day-to-day realities. That's why our focus in this research is on liquid savings, access to credit, and the ability to keep up with bills. So in this presentation, I'm going to take you through the good news, the not as bad as we thought news, and then the ugly. So let's start off with the good news. So consumer debt, things like credit cards, overdraft, loans, and car finance, plays an important role in financial lives. It gives families the ability to split up large costs, and most importantly, the ability to handle shocks when savings aren't readily available. And one bit of good news is that consumer debt per person has fallen massively over time. So as you can see from the chart here, debt surged in the early 2000s, peaking at around $5,700 per person in 2005. And since then, it's fallen massively. So now debt is at the lowest ever on record at about $3,300 per person. So as it stands, families are now carrying less consumer debt than before the financial crisis. And this has been specifically the case for low to middle income households as well. So as the chart shows here, starting from around 2006 going down to about 2022, on average, low to middle income families hold less debt than before the financial crisis. And though debt for things like hire purchase, which includes car finance, has gone up a bit, what we can see is that for debts like formal loans, credit cards, that's gone down massively. However, Household resilience depends on the other side of the balance sheet, which is savings. And there's good news here too. Over time, more low to middle income households are finding themselves being able to save. So what this chart is showing is that actually the prevalence of low savings amongst this group has fallen. So between 2006 and 2022, the share of families in the bottom half of the income distribution with less than £1,000 in savings has fallen from about 63% to about 43%. And most of this progress has come after 2012 as the economy recovered and continued through the pandemic when many households built up extra savings during lockdown. Now onto the not as bad as we thought news. So we know the pandemic happened and we know that was immediately followed by the cost of living crisis. If we were to follow the traditional view of household balance sheets, we would have expected for things to have seriously deteriorated. However, analysis has shown poorer families' balance sheets have held up much better than we expected. So on the debt side, what we see is that little change between the pandemic through the cost of living crisis. Here, the chart shows the proportion of low to middle income households with outstanding consumer debt. What we see is that this didn't really change during the cost of living crisis. And this is the most up-to-date survey data that we have. If we then move on to savings, what we see is that there was a slight dip in the share of those who were able to save regularly during the cost of living crisis. We see that this dropped from about 58% in the pandemic to about 52%. But what we can see is that actually this dip just took us back to pre-pandemic levels, and actually those who are able to save regularly, the share for that is higher than it has been over a longer period of time. So if we were to take the traditional view of household balance sheets or of financial resilience, then we might conclude that the cost of living crisis had fairly minimal impacts. Well, now onto the ugly. While debt in times of trouble can be an indicator of financial stress, falling behind on bills, otherwise known as priority debt, is an even bigger one. This is because falling behind on your bills can carry serious consequences. For example, if you miss your energy bill, you can be forced onto a prepayment meter. If you're behind on your rent, you can be evicted. And if you're behind on council tax, you can face the risk of going to prison. And what we found is that in recent years, there has been a rapid accumulation of those who are falling behind on their biggest household bills. Take, for example, energy bills. Prices soared during the cost of living crisis, and as they soared, arrears doubled. We're now seeing close to 1 million customers now behind on their energy bills, and average debt has grown from balances of around £500 to about £1,400. In fact, the aggregate stock of energy arrears has risen from 1.7 billion in early 2019 to about 4.2 billion by early 2025. And then when we look at council tax, we see similarly that arrears are up by almost 50% in real terms since 2019-20. And while some of this spike was reflected in court closures during the pandemic, arrears continue to rise during the cost of living crisis. And when we look at citizens' advice clients, particularly those seeking debt advice, it tells us the same story. The average citizen advice client is now more likely to be behind on their priority bills than they are on credit cards. This chart is essentially showing that since 2019, debts linked to essential bills like energy and council tax has climbed, whilst credit card debts have fallen by nearly a third. And this trend is no longer confined to just the poorest of households. Instead, what we're seeing is evidence that the incidence of going into arrears is creeping further up the income distribution. So essentially, if you look at this chart and you see number one is the poorer end and the further end is the richer end of the income distribution, if we were to look at quintile 2, for example, figures are showing that 15% of families in the second income quintile were in arrears in 2023-24 compared to the single-digit levels we saw just a few years ago before the pandemic. So why is this all happening? Well, we can point to a few reasons, with the most simplest one being the fact that bills are just simply more expensive than they used to be. Energy prices remain much higher than pre-pandemic levels, and council tax is set to keep rising indefinitely, with dwindling support for those on the lowest incomes. But there are two other factors we can point to. Firstly, borrowing has become really expensive, or more expensive than it used to be. Since the Bank of England began raising rates in 2021, credit card loan and loan interest rates have risen sharply. And at the same time, lenders have tightened their lending criteria. As a result, this has disproportionately affected those from poorer income households' access to credit. Secondly, action from Ofgem has softened some of the harshest consequences of being in arrears. This means it's less scary than before to fall behind on your bills. For instance, the number of disconnections that used to take place for gas used to run into the hundreds every year, but now it's virtually zero. Similarly, forced prepayment meter installations stopped entirely in the depths of the cost of living crisis over concerns over vulnerable households. So a combination of all these factors can help us explain why and what is happening. We know, though, the reality of managing household finances is not simple, and there is actually a complex interplay between savings, credit, and bills that shapes household decision making. In fact, families think about money in very different ways to the lens that we have presented here. And in our conversations with the financial decision makers of low to middle income families, we heard a range of views on how best they manage their financial situations. And I'll read a few quotes. "My bills are paid like touch wood. I have never ever missed a bill in my life. And if I don't have money to eat, I'll put that on a credit card. I would never ever miss a bill. That just doesn't happen." Someone else says, "I'd rather take advantage of the interest-free rate on a credit card instead of using my cash savings. So it gives me a little longer to pay it off, and it doesn't take a massive chunk out of what I've got left." And then someone else says, on bills, "We always prioritize those. So council tax, rent, and electric, and everything like that, we always do those first. The other thing I'd fall behind on is my personal debts. Those loans and credit cards is mine, and they are my responsibilities. I have fallen behind on those due to the nature of my work." So from these quotes, we can see the differences in approaches and attitudes different families have. For some, savings are more important than credit, and for others, it's the other way around. Ultimately, families are doing what they believe is right for them. So, given everything that I've just shown you, what can we actually do to solve this? Well, we have a few options. The first option would be to help households help themselves by helping them to boost their savings buffers. One approach to this could be to auto-enroll workers into their workplace savings schemes if they have them. Alternatively, we could extend auto-enrollment by adding a sidecar savings scheme, giving families the chance to build up liquid savings alongside their pensions. We could also focus on raising awareness and updating targeted schemes like Help to Save. But savings alone won't cover every eventuality, and therefore improving access to affordable credit is also really important. Third, when we spoke to participants in our interviews, it was striking how many mentioned financial education. But this wasn't essentially a call to add another thing to the national curriculum. Instead, people in debt that we spoke to wanted there to be much greater access to financial education and advice at the point at which they had to make difficult financial decisions. But we also can't ignore the fact that bills are rising and are much higher levels than they were before. So schemes to support those on the lowest incomes with these high-cost bills are really important. This could take form in the shape of a social tariff or stronger council tax support. And finally, we need to do something about the legacy of energy arrears that has already been built up. Ofgem have proposed a debt relief scheme for those on means-tested benefits, which I'm sure Tim might have more to say about. Ultimately, it's vital policymakers focus on strengthening support, easing essential costs, and helping families build long-lasting financial resilience. Thank you.
Thanks very much, Felicia. And I think it's really nice for us to have some good news as well as some ugly news. I think one thing worth bringing out, just seeing some of the questions online, is we have done lots of other reports on income, and it is very clear that families are feeling extremely squeezed, and so we need to think really carefully about how to interpret the patterns here in savings and debt. And actually, if people are saving more because they're feeling that life is more precarious, for example, then the good news can also be tinged with bad news. But I'm sure we will dig into all of that in the discussion. The other thing is obviously the kind of level versus the trend, and we've seen slightly more savings into liquid savings, but still 1 in 2 of low and middle income families with less than £1,000 of liquid savings. So we're trying to give you some optimism, but we're definitely not saying that things are fine, far from it. And Vicky, it would be great to hear how this feels from StepChange perspective.
Yeah, no problem. Firstly, thank you for inviting me to speak on the panel. Really appreciate it and very much welcome the report. Reports like these very much help us as an organisation to sort of bring the bigger picture and understand what that means in the context of the people that we help. And we very much actually recognise the picture that this report paints. However, I think we do need to delve a little bit into the clients that we see, who are people who know that they have financial difficulty and are seeking help with that financial difficulty. And the picture's similar but slightly different, sort of to your point. So we've seen the number of our debt advice clients in arrears on household bills literally increase relentlessly over the last 5 years. So the proportion of clients in energy arrears and the amount of that arrears has increased by over 100% since 2019. So 4 in 10 clients that we see are in arrears with their energy, and they have an average debt of over £2,300, so really significant burden on those households. We also see lots of arrears on council tax, housing, and other bills like water and telecoms too. So the proportion of our clients with credit debts have been relatively stable, so similar findings to what's in the report over the last few years, but slightly different to the national data is what we have seen is increases in balances within those debts. Now, this may well be because the people that are seeking advice tend to juggle for a period of time to the point at which they seek advice. So we know people wait on average 12 months before they seek advice with their debt situation. So it's quite possible that these people have started to build debt later down the line than some of the national data suggests. However, we have seen a decrease in overdraft debt and also payday loans. In each case, this is quite clearly points to sort of the regulatory interventions that have happened in relation to unaffordable lending. So that has had an impact on that kind of debt type. It was interesting reading the quotes from the interview participants in the report talking about how they feel like every day is a bit of a juggling act in terms of their use of credit versus their payment of everyday bills versus even buying food. So they're really having to make those day-to-day decisions about really difficult trade-offs, and that's what our clients say to us every single day, where they're making the choice between do they pay their everyday bills, do they put food on the table, do they buy their kids' school uniform, or do they pay their credit debt. So that is something that we hear about regularly, and the real fear of consequence of what they don't pay, what's going to happen to them if they don't pay. So as I mentioned earlier, we know on average people wait about 12 months before they seek help. We know that over half of our clients have waited at least 6 months before they've sought help, which obviously then their situation starts to spiral and the options available to them become fewer as well. So seeking help is obviously really, really important. So as the report highlights, getting an early grip on your financial circumstances is critical. One of the strongest points of feedback that we get from our clients after advice is the relief they feel, that it's taken away the worry and the anxiety. And even though there may not be an instant resolution to their situation, the fact that they've taken that step and they've got a plan of action generally brings that through. Just coming to kind of the policy points that the report highlights, as an organisation and myself, we're happy to endorse the policy points raised in the report. StepChange is very much pushing for a fairer and more effective ways of dealing with household debt. I mean, the basic principle is that we want those in arrears to be supported. with sustainable actions like affordable repayment plans, like access to high quality advice, and like not being pressurised into more harmful ways to cope with debt, or pushed into borrowing to make their situation worse often as well. So many of our clients, by the time they come to us, already have entrenched problem debt because they have not got good advice early enough, and because they are concerned about the consequences. So particularly around household bills, they're concerned about the consequences of not keeping up with those. So you mentioned earlier about potentially being evicted or potentially being sent to prison or other things. So therefore will borrow to try and resolve that situation, which actually can be more harmful in a lot of cases as well. So we've been campaigning for years actually about reform of the outdated council tax collection processes. So we are pleased to see the kind of government recent announcements about looking at council tax enforcement, and also looking at regulation of the bailiff industry as well. So we welcome those, and we think putting the voluntary enforcement conduct board on a regulatory footing is a sensible way forward from that perspective. We also very much welcome Ofgem's proposals for an energy debt relief scheme. Really, we want to see those low to middle income households be in a position where they can get the relevant support to deal with the significant arrears that have been built over that period of really high cost energy. But as well as the potential debt relief scheme, it's also really important that organisations work to offer the level of support that individuals need if they're struggling to make their energy commitments alongside paying off arrears as well. So we've been impressed with the action that Ofgem has taken in the last few years to sort of raise debt collection standards. And we, as an organisation, we work closely with a number of suppliers who are very much building and improving on their collections practices. So we can see what can be achieved when the will is there to make a difference in how we work with individuals in financial difficulty. But there is still some bad practice out there, so we would encourage Ofgem to continue to work with organisations to spread that best practice that's going on and cut out poor practices in that sector. We're also very big supporters of the Help to Save scheme. I think it's incredibly important that even people struggling with some level of debt have the ability to save even small amounts. I think building that rainy day pot alongside repayment of debt is a way to build true resilience for the future for individuals as well. So we would like to see when the scheme extended from 2027, but also look at how we could bring access to a broader range of people, so not necessarily just people on means-tested benefits, but potentially low-income earners as well. We, as part of our new strategy that we launched in March, we're shifting some of our focus to not just be about point of crisis support, but also look at building financial resilience for the future. So we're actually very passionate about individuals having the ability to put away a small amount of saving alongside repayment of debt, whether that's through Help to Save scheme or if that's not available through other mechanisms. Because it would be fantastic if when people come off some form of debt solution, not only are they debt free, but they have a small pot of money to help them be resilient to the future and avoid them falling into problem debt again. And also have advice on how to continue to build on that savings habit when they have a bit more disposable income available to them because their debt is repaid. So that's something we're working really closely on as an organisation as well. Of course, not everyone can afford to save, so we campaigned for and we welcome the Crisis and Resilience Fund available to local authorities. We think it's important for crisis funds to be available to people who need it to avoid, again, harmful debt going forward. Ultimately, we know these challenges of arrears, debt and financial resilience are all connected to cost of living pressures. So alongside the improvement in debt collection, and the steps that are required to help people cope with unpredictable costs and building a level of savings resilience. It's also important for the government to have a focus on bringing down bills like council tax and energy for those who really can't afford to pay.
Great, thank you so much, Vicky, and really insightful. And I'm really pleased you brought up so many policy solutions, including on council tax, where we're going to talk about energy, I expect, quite a lot, but I think perhaps we need a bit more attention on council tax too. So thank you very much. So Tim, energy does sort of stand out in some of our graphs, and it creates big problems for households, but a big challenge for the sector as well, and something you've been thinking about hard at Ofgem, I know. So really interested to hear your thoughts.
Yeah, absolutely. And thanks very much for inviting me. It's a really important topic. As you say, it's a massive topic in the energy sector at the moment and a big issue for Ofgem. And look, I think the report highlights quite an interesting and nuanced position, and it reflects what we are seeing in energy. Clearly, I mean, if you look across the piece, we're seeing debt as a whole go down and savings going up, but we know that is sort of masking the experience of a lot of people who are still living very much a sort of hand-to-mouth existence and juggling some of the different pressures that they've got, as Vicky described. I think just to say a little bit about what we are seeing in energy. I mean, you quoted the headline figure, and it is a stark one. I mean, the arrears were around 1.5 billion at the start of 2021. They're now around 4.15 billion. I think there are two things about that figure that worry us, apart from the size of it. One is that it's not going down. The pressure is still upwards, and around 3/4 of that total debt is owed by people who are not on repayment plans. So that is about 1 million customers who aren't paying anything towards their outstanding debt, and that is obviously a significant challenge for the sector. And I think there are broadly three reasons for that, really. Some are more obvious than others, I would say. I mean, the first one, clearly, I mean, prices are higher. As you point out in your report, we think they're around 15 to 20% higher in real terms compared to pre-crisis, and perhaps not gone up as much, certainly in the last 12 months or so, compared with other essential costs for people like rents. But clearly, we are paying more for our energy. A lot of people built up significant debt during the crisis when the bills were particularly high. Even with the huge amount of government support that was made available, we were still having an equivalent price cap of around 2,100, I think, compared to where we are now. And that has left a legacy of debt with customers who are then struggling to continue to pay their current bills. And then I think the third issue is and it is reflected in your report and is possibly one of the more challenging ones for us collectively as a society and for us as a regulators. We are seeing, I think, a shift in prioritisation of people's approach to debt, and we are seeing that energy is becoming a debt that is, and I think there is some evidence that it is not being as prioritised as much as other debts in the way that it was in the past. I think that's something we want to reflect. So look, what are we trying to do in Ofgem? I think there's three or buckets that we're trying to address. I mean, the first is that, I mean, our core job is to try and drive down on all the costs on the energy system. So we don't set the costs in the energy system, but we do, well, not all of them certainly, but we certainly have a responsibility to try and drive down on the costs that we can control. That's operators' costs, that's the cost of the networks, that's the cost to a certain extent of some of the generation. Now that we are building a new energy system, and those costs are coming through into the system, and so there is pressure on bills. We try and keep them down as much as we can, and as I say, for the last 12 months or so, we start to see a little bit of a stabilisation, but we are still very vulnerable, of course, to the primary source of energy bills, which is the wholesale price, which is we are currently relying as a country on an international market for gas, which, as we know, can do some very volatile things. So I don't think we can take too much comfort in the stability at the moment. But the second thing we're doing, as Vicky said, we have pushed very hard in the last couple of years to work with suppliers to try and improve their practices. So there are lots of things suppliers can do, and I think they are getting better at it, to be fair. I think accurate billing, intervening early when people are starting to get into debt, offering reasonable repayment plans and engaging with them and applying appropriate debt standards when we've worked very closely and well and benefited from the advice from debt charities on how to do this. The other thing we're doing, as has been noted, is we are introducing this debt relief scheme, which we're hoping to have in place for this winter. And this is very much looking at targeting that historical debt that built up during the crisis, that people are just really struggling to get on top of, and it is inhibiting their ability, I think, to engage with the market on an ongoing basis. It's a complex scheme. It's new territory for Ofgem. It's new territory for any regulator, I think. But we think it's an important thing. But then the third issue, which it comes down to this question of prioritisation. And look, I think that and perhaps trying to prevent people getting into debt in the first place. And I think there are some things that we need to think about in the energy sector, and it'd be good to sort of get a sense of that during this discussion. But I think what Vicky said about people engaging with help and trying to seek help, it very much chimes with what we hear from suppliers. So quite often, by the time people are contacting suppliers, they've racked up quite large amounts of debt, and of course, with energy bills being higher, that happens much more quickly. We also see big sources of debt from things like changing tenancy, for example. So I think one of the suppliers has told me recently that on average it takes around 17 weeks to engage a customer once they've moved into a new property to get them to get in touch with the energy supplier. In that time, they are receiving energy, and so on current bills they're racking up £500 to £600 of debt often before they've even made contact with their energy supplier in the first place. I think that's something we need to look at, frankly. And I think around prioritisation, we need to get the right balance, and we've got a responsibility to all consumers, and well over 90% of consumers pay their energy bills, and lots of them are making very difficult decisions to make sure that they are paying them. And the costs of the debt in the system are now quite substantial. So that £4 billion debt is translating into a large amount of bad debt, which is pushing up in itself, putting a pressure on bills as well. So they're all paying around £70 on our bills for the cost of bad debt in the system, and that number is only going to get higher if we can't get on top of this. So I think we have to get on top of it. I think we've got some plans to try and intervene in the market soon on the debt relief scheme, and we're working on continuing to work with the suppliers on their approach to recovery of debt. But clearly, and as I think your report highlights, energy is now a bit of an outlier, actually, and I think that is something that we're going to need to address.
Thanks so much, Tim. Really interesting, and really appreciate your reflections. We'll come back to lots of those suggestions in the discussion of policy, I expect. But Seb, let me bring you in first, and really keen to hear how you see a lot through your customers and how that chimes or not with the report.
Thank you. Yes, and thanks for the opportunity. From our perspective, so we start off with having some view of about 14 million customers in the UK. Of that 14 million, about 50,000 in any 1 month will put their hand up and put a call into the bank saying, I've got some sort of problem. Echo the early intervention points. Our staff are amazing at helping customers deal with their problems. But even against that, there are about 2% of that flow, so about 1,000 a month, who we will assess are either so entrenched or such complicated circumstances that they need help that's beyond what we can offer, and will be referred to either StepChange or a similar partner like PayPlan. And a little bit of flavour on who is in that kind of category. It's echoing the kind of focus on lower to middle income households. The typical characteristics are about 40 years old, income of between 20 and 30,000 pounds. But what's particularly revealing is that 95% of these people are in work. So this isn't about redundancy shock. This is about everything having just mounted up and got too difficult. And what we've seen change recently over the last year in particular is the sources of debts have multiplied. So the average referral we're now making has at least 9 different sources of debt that they're behind on, which points to the sort of systemic issues and really, I think underlines some of the recommendations you've made through the policies there. Stepping back and thinking about the research a little bit, a quick hat tip to Felicia and Simon. Well done for crunching the numbers, because actually it's surprisingly hard to get good data on the balance sheets of households across the UK. We get monthly stuff from the Bank of England of what's in the total, which is great. But in terms of zooming in on what that means for individuals, it's really hard. And part of that is made even harder by the fact the distributions are so skewed, especially on savings. So a sprinkling of optimism. Looking at our own customers here, we can see that aligned with the conclusions of the report, there are glimmers of this period of wages beating prices, which we haven't had for quite some time, has trickled down and had some impact helping out those who needed it most. So we think we've seen about 1 percentage point improvement in the number of people who are using their overdrafts. We think there's about 1.5 percentage point improvement in the number of people who we would define as having low financial resilience. So have you got enough cash to cover a minor emergency? But those levels are still really high. So you're still looking at about 1/3 of people who will see during the course of a normal month their cash and liquid savings drop to below £200 through their current account and instant access. So lots of support for welcome for people able to build up buffers if they're able to. But there has been a lot of saving happening. Actually, a surprisingly large amount for us and for others. I think that the lens which I would point to here, which we think is quite interesting, is the parts of the population really driving that increase in the saving has a really strong age structure to it. So if we look at our own average balances in the savings accounts, we can see 18 to 35s have seen an increase in saving over the last 12 months, about 2.5%. A little bit more for the 35 to 50-year-olds, up 4.5%, but it's the 50 to 65s who really managed to accrue the biggest increase in balances, seeing their savings grow by 11% over that period. That feels like that stacks up because they're less affected by higher mortgage payments, less likely to be affected by pretty rapid rising private rental payments, which is a big issue further down the age spectrum in particular. And so we have seen an increase in the kind of share of saving undertaken by older households, as well as that little bit of improvement in resilience around the edges to other households as well. Final plea on the policy side, ISAs are a phenomenal brand name. Customers like them, they understand them, but we have such a complicated financial picture in terms of well-intentioned interventions available. And it's the engagement with finances that is most effective to help people do sensible things and keep out of trouble. So a plea would be to be really sort of respectful of customers' individual choices that they face and make changes that make things easier for them rather than putting up more ring fences or structures which are going to be really complicated for people to understand, engage with, and then realistically be used by the people who we want to get most benefit from them.
So you wouldn't want to see any reduction in the flexibility to choose cash or shares in ISAs, for example?
I think increasing the flexibility would be a good thing. We think more people would benefit from being able to invest. So let's break down the barrier between a cash ISA and an investment ISA.
Great, thanks, Seb. It's so interesting to hear the data, and that point about age structure fits with a lot of our work on income. So it makes a lot of sense, but really interesting to hear it that way. I think there is a sort of elephant hanging through this discussion that I just want to get people's take on, which is why have we seen this huge spike in energy arrears? Now, on the one hand, we've seen a huge spike in energy bills, so maybe it's obvious, but it seems unusual that the debt is accruing in exactly the same place as the bills. And actually, we found in our qualitative research, Vicky, you said, there are still a lot of people who see going into debt on their household bills as particularly something to avoid, or particularly something that worries them. Tim's talked about a shift in prioritisation. We're talking about a 20-year period, and so Seb, we've seen this collapse in we've seen a reduction in the availability of consumer credit, but none of us probably think that the kind of supply of consumer credit in 2007 was the right one. So this might be a kind of sensible shift, but the balloon is kind of popping in energy. So I suppose I just wanted to get people's reflections on what is really driving people to fall into these higher arrears. Is it less availability of credit? Is it simply where the balloon is popping in terms of the pressures on families? And Vicky, what do you think?
Yeah, well, there's a couple of things to comment on there. So since the cost of living crisis started, that has accounted for, at its peak, about a quarter of people saying that was the reason they were struggling. So sheerly being able to make ends meet was the reason why they were in debt or they were struggling and they couldn't cope. Now that has reduced to about 18% this year, but it's still high, where historically the main cause of people struggling with things was a life shock, really, whether that was redundancy or bereavement or divorce or what have you, that kind of thing. So there really is genuinely an issue with people being able to make ends meet. But I do think that is coupled with the tightening of credit as well. So where people went before was, I can't pay my bills, so I'll borrow, I'll withdraw cash on my credit card, or I'll go into more overdraft, or I'll get a payday loan. And what we're seeing is less use of credit for that reason. And I think if people are experiencing better collections and forbearance practices in sectors like energy, the fear factor goes a little bit more as well. So I think there's a number of things at play. So that it's a good thing that there's better forbearance and better practices, but ultimately people are going to make different priority decisions. What we see is people tend to make the priority decision where the pressure comes from, and that sort of is shifting.
So that means that that high energy prices are the kind of fundamental driver for you, because people tend to miss the hardest bill to pay. Does that make sense?
Yeah. So well, I think the high energy prices is an issue. So people are either they simply don't have the money to pay it, and therefore they can't borrow to help because they've got to that position. If that makes sense.
Exactly. Yeah. So Tim, what do you think? Should SEB be lending to these customers so that it's not down to the energy companies, or how do we sensibly transition from, what's actually happened is energy companies becoming a provider of credit in a way?
Yeah, and I mean, there's clearly a sort of waterbed effect here, isn't there? The pressures are sort of getting, the ability to relieve pressures in certain places is getting taken away, and then it's going up in other places. Look, I think it's absolutely right. We've improved forbearance and customer standards in energy for people struggling with their bills, and I think it's absolutely right that we're focusing support on them. But it clearly is not a long-term solution to the problems of debt in society for energy companies to act as a source of credit, and in effect, that the costs of that, that they fall somewhere, and ultimately they will fall on people's bills, I think, and that's a very sort of, I would suggest, quite a poor form of redistribution. So I think there does need to be some sort of holistic look at this and look at the role. And I suppose, I mean, it was interesting what Vicky was saying about people going where the pressure is the most. I mean, I interpreted that in two different ways, and just want to check that I'm right in that. I mean, I suppose one of which is the amount of it, does that form the pressure, and the other one is, I suppose, are the consequences. Now, I mean, I always go back to the fact that in the last year before the privatisation of the energy market, 100,000 households in this country were forcibly disconnected from their energy supply without any sort of support. And the reason I picked that time is because it was the state effectively doing it. It wasn't private energy companies. Now, we clearly do not want to go back to those days, and we clearly don't want to go back to a world or have experiences where people are getting very poor debt support from their energy supplier. But I think we do need to think about what the role of the energy market can feasibly be to manage those costs. And so I think there is something about we can try and get people into the system, try and get them help support, get them to debt advice charities, but where they can then go for credit and support that is a more long-term feasible solution for us as a society, I think is something that is going to be needed.
Seb, anything you want to?
I think the perspective I'd add is that we're seeing customers' preferences for how they manage their financial burdens shift quite rapidly, and in particular, the desire to be able to manage more of these things digitally through your apps, and get visibility of where these payments are coming. And that's where I think probably on the energy side, there's a very wide range of approaches that the providers have with your ability to get visibility and predictability on how much you are going to owe. And that's because of the changes in prices. That is a novel kind of thing that the industry is having to deal with. So I think that probably has quite a significant role to play in how this has come as a surprise or a shock to so many households across the UK.
Really interesting. I might just bring... Oh, Tim, did you want to come back in?
Well, if you did mind, because I think that touches on a really important point, actually, which I wanted to make. I mean, we talked about prepayment meters, and they're referred to in the report. I think there's a really big distinction between the traditional, what we traditionally think of as a prepayment meter, which is a key-operated meter on the wall or coin-operated meter on the wall, which, frankly, I think we'd all like to see the back of them. The sort of smart prepay experience is actually very different and gives people exactly what Seb is just talking about. So it gives them real-time visibility of what they are paying and what they are getting for it. And actually, we find in our customer research that customers on Smart Pay As You Go are some of the most satisfied customers. It's also now the cheapest way of buying energy on the market. And I do think it is a really important tool in helping people to manage their energy bills. And we should distinguish, I think, between what that offers and the sort of traditional prepayment model, which I would be more comfortable with the description of in your report of the prepayment experience for those customers. But I think actually for Smart Prepay, it is very different. And I think Smart can play a really important role here.
Do you agree with that, Vicky? Do you see that in people coming for advice?
Yeah, because I think some of it's about having control, it's about being able to Tim's point, to understand how much you're paying, when you're paying it. Do you need to take action now? So, we work with some of the energy organisations at the moment, and we offer energy advice alongside debt advice. So there are ways to reduce your expenditure and keep on top of that. So having that visibility and having that control for a lot of people is very important.
Great. Well, look, before I move us on to policy solutions, I wanted to bring one question up online, which we touched on, but I think is important to come back to. And if anyone in the room would like to ask a question, then wave at me and Mike can give you a microphone. There is this potential tension between what we're saying here about some of the aggregate trends, where we've talked a lot about the energy sector, but we do find overall that actually there has been a slight increase in saving and a slight reduction in other forms of debt through this period, although I think important to say that in our report, most of the data ends in 2022, and while we've tried to look a bit further, obviously that means we're not fully capturing the real cost of living crisis. But I just wanted to pause on this question because, you know, we haven't seen a reduction in material deprivation, quite the opposite. And so as we talk about this aggregate trends, I think important to acknowledge that means there are families not seeing an improvement in their financial position at all, and that we're seeing kind of improvements, as I said earlier, from quite a low base. But Vicky, I wondered if this was something you might want to add to.
Yeah, I mean, I think we were talking about it earlier, really, weren't we, as well, that actually it is for a lot of people, it's not a credit debt problem now. For a lot of people, it's surely about, I can't pay my day-to-day living essentials. So it's for people like that who will be using food banks to support their day-to-day living. You know, the FCA's Financial Lives survey found in 2024 that 30 million people in the UK have low financial resilience. And YouGov polling that we did recently showed that 4 in 10 UK adults would not be able to meet an unexpected cost of just up to £1,000. So there still is a lot of people out there for which life is very difficult at the moment.
And because we've dwelled on energy, I think just to come back to council tax, as you said, and as Felicia said, the consequences of falling into arrears on council tax can be extremely severe. So the fact that we're seeing those spike surely means that this isn't just about a reprioritisation of debt, it is also a symptom of some people in real difficulty.
I mean, absolutely. So we've talked, as you say, specifically about energy, but what we find is the majority of our clients, if they're in arrears with energy, they're also in arrears with council tax, and they're also in arrears with their water, and they're also in arrears with sort of telecoms and potentially rent or mortgage. So it tends to be across the whole of their priority bills, not necessarily just one.
Yeah. Really interesting. And Seb, it was really interesting what you said earlier about 95% of people are in work, and it's not tending to be a redundancy shock that's causing people to phone up. Can you tell us any more about the sorts of patterns that you see?
Yeah, absolutely. So I think strong interconnection with health, and we've mentioned it previously as well, but about 60% of customers who we would refer for specialist advice would have some sort of self-disclosed vulnerability across the spectrum. So really strong co-determining factors that is the reality of life that lots of families find themselves having to deal with. I think in particular, and getting slightly to the question that's been put to us on food banks, you know, we are able to say that at aggregate levels we have seen rates of income growth beat prices, but within that there is a huge distribution because people will face rent increases that tend to be quite spiky associated with change in tenancy. Yeah. Even as we say blithely that wage growth is strong, the last time I checked, the single most common pay increase was still 0 as a median level. So that's the modal outcome for a lot of people. So there will be plenty of people who miss out on a good year and therefore face a material kind of change in their living standards. So we can never assume away the kind of full distribution of effects that we see on people.
And Felicia, anything you wanted to add from the qualitative work that you did on the report?
Yeah, definitely. I was actually going to make the point that in the report, we have a chart that shows that even though we have a growing share of low to middle income households who can afford to have money left over, the vast majority still aren't able to. They don't have money left over at the end of the week. So there's still a large proportion of families who are just not able to make ends meet, just echoing the thoughts that has been said on the panel already. And I guess when it comes to the interviews that we did with our participants, I guess what we're finding is that each individual family, like circumstances are unique. So everyone is doing the best that they can with their specific circumstances. And like when we spoke to people, the difference between those who are able to save regularly versus those who aren't is literally like a life shock. It could be illness, it could be bereavement. And even if they did have a savings buffer before, it was only that one life shock that could take them into a debt spiral. What we also found interesting was how people prioritize different things as well. So for some people, their savings were so precious that they would rather like use credit cards. And then when they couldn't, if they had no savings or they had no debt, no savings or no access to credit, they would then have to rely on either family or friends to really get out of financial hardship. And even things that we wouldn't have thought of, like insurance, became an important lifeline for them, especially for people who were homeowners as well in difficult financial situations. So it really did come down to like this complex interplay of like the savings, debts, access to credit, all of that is affecting people's positions. But there still is a vast majority of people in this group that we're speaking about who simply aren't able to make ends meet. So
I think I'd just add to that, we recently released a report about the disparity between men and women as well. And actually what we see is that women are really overrepresented in the number of people, in the people we support.
Right.
And specifically linked to the challenges of the cost of living crisis, partly and particularly if they're single parents. And that's really because a single income household with childcare responsibilities, etc., is hugely trying on households.
Yeah, absolutely, and that very much fits with the income data that we've looked at in other reports and the unfortunate forecast we have for continued rising child poverty, where single parent families are a really important part of that story. Let me move us on to policy proposals and what we might do about it. You all touched on this in your opening remarks. We have a very difficult question online, so let me throw you an easy one as well, and then see if you want to answer the hard one too. So my easier question was going to be, I think we had a lovely range of policy suggestions as we went round the panel. If you could sort of do one thing to help, let me force you to choose where you think the government should focus its efforts in terms of policy. And then if you'd like to take on this much harder question, I think it's fair that we're focused here a little bit on the symptoms of what is really an underlying living standards stagnation over the last 20 years, but there are some quite deep structural issues here, as we've talked about, both for household incomes, but also for the energy and the consumer credit sector. Who would like to tackle those? Felicia, I gave you a bit of a warning, so I'm going to come to you first. If you could do one thing, what would you do?
This is difficult asking the person who wrote this to choose one. I might be a bit of a cop out and say multiple. So firstly, I think it's really important to help households help themselves. So in terms of the side of helping them boost savings where possible, and also affordable access to credit as well is really important on that side. But then on the other side, where they're not able to control, is tackling the high essential costs. So actually providing support for the most vulnerable households, whether that be on extra council tax support, because that's been dwindling over the past few years, whilst the council tax is going up, and the consequences for not paying are really bad actually. If you miss one payment, you're all of a sudden liable for the rest of the year's payment, which is bad. So, tackling things like that to really help households. I guess it's a bit of a cop-out answer. So I'd say the stuff to help people help themselves, but then also tackling the high costs and support for those households, families.
Great. And I just on council tax, not to miss an opportunity, we have been doing some work at Resolution Foundation to dig into council tax support and how it varies across the country. And I think there probably is scope for improvement there, but that will be out in a few weeks' time. Vicky, a favourite and a structural, what do you think?
So I think a key thing is about increasing the affordability of essential costs for low income households, and there are a number of things that the government could focus on to do that. Firstly is looking at relinking housing benefit to the lowest 30th percentile of rents, because the cost of rent has gone up exponentially and the cost, the housing benefit hasn't. So I think that's really, really important. I would say boosting national funding for council tax support. So to your comment you just made earlier, it's really inconsistent across the UK. It's a bit of a postcode lottery how much support individuals get. So I think consistency there would be good. And then introducing national social tariffs for both energy, water, telecom. So we can't just focus on one, I suppose, would be my view. The cost of living in general, as I mentioned earlier, people aren't just in arrears with one, they're generally in arrears with them all because they can't afford any of them and they're juggling to determine what to do. That would probably be my view.
Great list. Seb?
I'm going to take a slightly different angle and hopefully combine the two and give a little bit of a shout out to employers. So the people who are struggling with this most are all in jobs, they're all in work. And we see a huge variety and a massive opportunity for employers, both public and private sector, to help engage their workers with financial issues in general. That works really well because you get people's peers together who are in relatively similar situations, and we know we learn much more about our financial choices from our peers than we do any formal source or anything else. And it also is possible to unlock some very meaningful policies and options that help people with their cost of living. So things like salary sacrifice schemes for owning a car. Very, very many of the people in difficulty will own a car, would be able to save money if they're able to buy that more tax efficiently through a scheme that their employer needs to have in place in order to be able to unlock. So we're doing more work with our corporate clients to help talk to their customer and help talk to their staff about how to manage that responsibly.
And employers a big role. You mentioned health earlier. In what happens when people experience a health shock and the consequences of that.
Absolutely.
Tim, what do you think about the area where you would prioritise? You're obviously in a position to do some of it as Ofgem, but you might want to mention wider things too, or areas where you think we really need to target the structural issues here.
Yeah, I mean, I'll largely stick to energy and dodge the structural question, if you don't mind, partly because I obviously have responsibilities as a civil servant, and I don't want to sort of drift into areas that are outside my responsibility. But I think we do talk to government about what we're seeing in energy and some of the things that are needed, and some of that is happening now. I mean, I think I would draw attention to two things. I think access to data in terms of helping to identify people who are really struggling and getting the right support to them is really important, I think, and we're going to see a bit of that through this debt relief scheme, but I think there's much more we can do that would actually help target support on those that really need it. And I think it would also, in a sector like energy, it would allow suppliers to make sure that those customers are getting the support, but focusing their recovery efforts on others. I think that's really important. I think we've long advocated more support for low-income consumers in energy. I think it's just worth pointing out in that the government is expanding the warm home discount quite considerably this winter. That's going to, there is a social tariff in energy. It's the warm home discount, and it's going to go to around 6 million households this winter. That is quite a significant intervention. I think the challenge with it is, as we and others have pointed out, that ideally you want to be targeting in energy. You want to be targeting those who are low incomes and struggling, and also have high energy bills. And that's quite a difficult cohort find and identify and support. But I think that is, if I was going to have a plea for intervention that would really make a difference in my sector, I think it would be that.
And in some ways, Tim, the 2 points you've made tie together, because the data challenges are part of the challenge of identifying the right group of customers, both once they've got into difficulty and where to target help, and where you might want to target things like a warm homes discount as most efficiently as you can. And one thing we've said at Resolution Foundation is that building the systems that allow us to identify those low income, high energy customers is both important for every day and could be very important in the future if we experience another sort of energy price shock, which, as you say, is somewhat out of our hands. Seb, the data point is really interesting, because I guess as a bank, when a customer gets into difficulty, you have the advantage in some ways of quite a lot of financial information about them, and therefore to understand what the right help is. I guess it must be a challenge as an energy company not to have that data. Do you think there are things we could do to help that? Advice you would give to the energy sector?
Information definitely is a really critical piece of this. We have a privilege to get fantastic data on our customers, but we're also cognizant that our customers have more and more financial relationships every single year, as the ease of use of different products and the innovation in the sector multiplies. So I think one of the things that particularly to help support policy we're going to need to do much more of is try to find ways in which we can pull that data and get a clear, timely picture of how these elements knit together. So it's great that Ofgem published the Arrears data, because we can see that directly. We're trying to do similar things ourselves in terms of sharing depersonalised financial data with an organisation called Smart Data Foundry, which other banks would be very, very welcome to join in with. And that will hopefully allow us to do exactly that, to see where the pressures are and see how customers respond to them.
And Vicky, that's where an organisation like StepChange can really help, because you can see the customer as a whole.
Yeah, absolutely. And part of our digital strategy as we go forward is working with the partners that we work with in all sectors to be in a position where we can start to share data so that they can understand where their customer is more broadly, but also what level of support their customers require. So that's certainly how we're going forward with partners at the moment.
Great. Before we wrap up, does anyone in the room who's battled the tube strike want to ask a question? I don't want to miss you if you do. Yeah, one there. And we'll take them both.
Thanks, everyone. I'm Jo Phillips from Nest Insights. I'm interested in the recommendation about financial education at the point of decision making, and also some of the really difficult trade-offs that many of the panel have described, and thinking about how difficult it is for people to know kind of how to prioritise for the best. And Vicky, your point about, it's the pressure that governs that rather than the financial. And to the data point, when people apply for credit, they will go through an affordability assessment, and some of them will kind of not get through that and be declined the credit. Are there things that we could do at moments where we see people where, they may be being turned away, where they could be helped to prioritise or kind of steered to support earlier than the kind of late stage at which people are reaching it currently?
Really interesting question. Thanks, Jo. One at the back as well.
Hi, it's Anne Fairweather from Arrears Lansdowne. Similar points actually to Jo. I think just on this point around financial information education, we ran a financial inclusion summit in Bristol actually with a load of local partners, and that really came out, meeting people at the point where they need the information. And I think to this question around employers, and it's really great to hear Seb bring them into the conversation, but how do you reach employers where they are? Especially small, medium-sized ones. And I think whether it's talking about could you put more into a pension for your staff, or whether it's talking about how do you get them to sort of, hand off to people like StepChange and the like, I think it's a really underutilised resource. Quite often employers want to help their colleagues, but they don't necessarily know, how to do that. And we did a project ourselves with sort of smaller businesses in Bristol precisely around this, but I think there's something that needs to be tackled across the board. because unless, I don't think it's about asking government to come up with the solutions, but I do think it's about putting it together. And just a final point on putting the data, if we could have a conversation around open data where it would be possible to see people's energy bills through open data, if they were willing to volunteer that information to their financial services provider, then that financial services provider be in a much better place to then talk about how to help structure that debt, and the degree to which that could then be automated, I think would also really help.
Great. Well, look, two great questions there, probably for Seb and Vicky, on how we make the most of financial decisions and how we reach employers. And then, Tim, to give you a heads up, there's a specific question for you online. So I will put that, I think I've managed to put that up. Oh, there we go. So we'll come to you on that so that I can bring everyone in for any final thoughts as well. Vicky, on those two questions about, and you spoke so powerfully about the advantages, both of you, about kind of early, getting support to people early. How can we make that real?
So I think there's a broader problem we need to tackle as a society, actually, so that effective use of technology actually reaches people, because there is still a huge stigma about debt in UK society. And one of the biggest reasons that people say to us that they didn't seek help earlier is because they were ashamed, they were embarrassed, they thought they weren't a good citizen. This coupled with everybody's absolute obsession with their credit file and their credit score, because there's been so much hype around boost your credit score, your credit score is really, really important. Those two factors mean people don't seek help. And I think that you can have the best technology in the world, but if somebody is in that state of mind, they're not going to consent to you sharing that information. They're not going to pick the phone up. They're not going to engage. And engagement is still a massive issue. And a lot of that comes down to stigma. And I think we need to collectively work on breaking the stigma around debt. It can happen to anyone for all sorts of different reasons. You know, I think about the success that mental health charities and organisations have had in terms of let's be open and talk about mental health. We need to have the same sort of seismic shift with debt and financial difficulties, because then the technology can come into its own and the data can be really valuable. But you can't do anything with data unless people consent to it. So I think that's a key thing.
Yeah, and what we're seeing in the data is that it is a common experience, and it is a common challenge, and something that can affect people for all sorts of reasons, as Seb said earlier. Please.
Yeah, I just wanted to come in and echo Vicky's points. In the interviews we had with people, there was a huge emotional aspect to it as well. Some people feeling ashamed that they were being a bad partner as well as a bad parent, and that's why they didn't seek help as early as they could. And I think in some of like the discussion groups when we were speaking to other organisations, they were saying how before in like during the pandemic was a really good time where some of that stigma was lifted, where people felt a bit more comfortable talking to each other about these like debt issues, and there was signpostage about where to seek help and how to do stuff. But I guess we've seeped back into pre-pandemic times where it's become a bit more shameful again. And so having some sort of something to help lift that stigma will definitely help people seek intervention a lot earlier than before.
So to turn that outward, our staff and the brilliant people who work at StepChange and other debt partners, they genuinely have seen everything before. They have absolutely seen everything before. 98% of the people who get as far as putting their hand up and calling their bank don't even need a referral to the very specialised advice that the debt partners provide. So people are fixing this when they make that contact. Completely agree with the stigma point. We're finding that relatively new innovation, I think it's 40% now choose to engage with us principally over WhatsApp rather than through having a conversation. That helps. It's absolutely meeting people with where they are in the in a format which is as easy as possible to reach is how we can get to people earlier and quicker, and that has to be a good thing.
Yeah, I would just echo that. So at StepChange now, of all the people we debt advice, 90% initially engage online. And 75% complete online. So there may be a level of interaction within that journey, whether that's over WhatsApp phone or web chat or what have you. But there is something about doing it at your own pace, you know, that anonymity, I can never say that word, but that to a degree supports that as well.
Yeah.
Yeah.
Really interesting. Tim, any reflections on that and the two questions we had, or on this specific one about, you know, I don't know the extent to which you're able to unpick this kind of prioritisation versus high bills?
Yeah, I mean, it's really difficult to unpick, as you might imagine, and then clearly it's a combination of things. And there's no doubt that the start of the rise in energy debt was about the really high prices we saw during the Russia-Ukraine crisis. And the continued relative high price of energy compared to pre-crisis is a factor. I think what we are seeing, and I think what the Resolution Foundation report shows, though, is that energy is now becoming an outlier, actually, in the trajectory of debt in gas and electricity bills is not going in the same direction as other sources of debt. And I think that does give us pause for thought, and it does suggest that I think that there is for some customers, there is some form of prioritisation, and I think we just need to be thoughtful about that and how we tackle that, and make sure that when we put in rules in place around the things that suppliers can do to recover their debt, we make sure that we just strike the right balance between the needs of customers in very vulnerable situations and the needs of customers as a whole who pay for the costs of that debt.
Mm-hmm. Well, look, I've really enjoyed the discussion. I think some really serious and difficult issues, some quite tricky trade-offs about how we support people out of debt, how we move through the kind of spike in energy arrears. But what I've really enjoyed about the discussion is so many contributions of ideas and ways that we could tackle the problem. So despite the challenges, it's left me feeling rather optimistic to have such thoughtful people to help us work it through. And thanks to Felicia and Simon for the report, and thank you all for coming.